Hi friends, welcome to Adda 24/7. We are in the BFM Important Questions and Case Study series. Actually, this series is for all the subjects. ABM, BFM, ABFM, BRBL. I am covering ABM and BFM. Others are covering other subjects as well. So follow the complete series. Share it with your friends. Share it on all your social media platforms. Like the channel. Subscribe to the channel. Do it first. Because on this channel you are getting all the latest updates. Plus free YT series. Objective questions, case studies, everything you are getting. So do it first. It's free, isn't it? So let's move on. First question. The process of integrating domestic market with the foreign markets requires free flow of capital, which can be through which of the following routes? So integrating domestic market with foreign markets. What do you mean by this? Understand this. See this. What do you mean by this? Firstly, understand the concept. Okay. Integrating domestic with foreign market. This is basically the job of, kindly note, the integrated treasury. Okay. Means the new treasury role which has come up is known as the integrated treasury department. What do you mean by this? It links the banking business to the external market business. Okay. Means the money generated from the deposits, basically from the sources of funds, deposits and borrowings, that is invested in various government bonds. That is done through treasury. Because loans are given by the banking department, and this investment is done by the treasury department. So that is known as integrated treasury. The question over here is capital flow. Means when the funds come in, suppose if somebody wants to make the investment in our country, through which ways can the investment be done? That's the basic logic of this question. Portfolio investment, ECB, issue of equity debt in global market. One. Second, FII investing in long-term funds in domestic companies. Payment for technology transfer. Second point. Third, royalties. Now what is this then? Which one is true when the funds come in? The answer is actually, okay, let me explain you one by one. See this. Portfolio investment means investment in, this is called as FPI investment. FPI. Foreign portfolio investment. I'll write it over here. FPI. Foreign portfolio investment. Okay. See this. I've shown this already over here. I'll write it over here. FPI. Okay. Foreign portfolio investment. Second is ECB. ECB means what? See this. ECB means external commercial borrowing means what? It's actually the loan taken from somebody. Now, before understanding this, you need to understand this capital and a current account. Current account means you do the business, import, export. You do the export, you get the money. Okay. That is fully convertible. Dollar is fully convertible under current account. All the remaining things like this portfolio investment, ECB, FIIs, payment in tech transfer, this A and B and C also. C is actually going out. So A and B. These are basically the part of the capital account. Here the dollar is partially convertible or rupee is partially convertible. Okay. So both this A and B become the part of capital account. So those are the answers. But what about C, royalties? Royalties means what? Whenever any company invests in some foreign company means, for example, Tata tomorrow, Tata is invested in this, which one? This JLR, right? So whenever JLR gets sold, some part of that comes to Tata's in India, Bharat, as a part of royalty. So that is basically the royalties part. So that is all of the above. So answer is all of the above. Scheduled commercial banks are allowed to borrow maximum of -% of the capital funds during the fortnight in call or notice money market. Difficult one. Very difficult one. Scheduled commercial banks are allowed to borrow how much? How much? Look at this. 125, 100, 75 or 50. Yes? Think of it. Answer is borrow. You're borrowing over here. So answer is this is 125%. Okay, borrowing. Kindly note, there's a classification in this. Understand this. See this. Whenever you are borrowing overnight means for one day, one overnight, okay, then you can borrow up to 150, 125%. But during the fortnight, your average borrowing should not go beyond 100% of your capital funds. Should not go. Then you'll say, how is this possible? If I'm borrowing 125% over here, how can this be 100% in 15 days here? If you borrow 125% in one overnight, some other overnight you have to make up for it. You have to borrow less than. You'll have to borrow 75% at that time, so that the average becomes 100%. This is for borrowing. And for lending is very smaller percentage. Kindly note. If let's say you are the bank, you want to lend it to someone, you can't lend beyond 25% of your capital funds. Lending is very less, and borrowing you can borrow up to 125 for overnight and 100% for average fortnight. Okay. Which of the following is issued for a tenure less than 91 days to meet the temporary cash requirement of the government? Temporary. Commercial paper, cash management bill, treasury bill, certificate of deposit. Which one? Answer is? The answer is CMB, cash management bill. Okay, CMB. See this, T-bills are 91 to 364. Okay, CMBs are below 91 days. Commercial papers are different. Those are long-term papers. Okay, the commercial papers are actually the replacement to T-bills, because in T-bills banks can only invest. In commercial papers, even the NBFCs can invest. CD is similar to, not similar, it is for the retail customer mainly. Okay. So now I would again suggest you, before going ahead, kindly subscribe to Officers Adda 24/7 English channel. Join the crash course 11th October. Starting 11th October. Join it ASAP. Huge discount offers are going on. Join the Mahapacks. In Mahapacks you are getting 15 plus batches. I'll show you at the end how to join. Okay. I'll show you. Let's continue with some questions, other questions as well. Under which method of value at risk calculation, VR is calculated using a sample of randomly generated price scenarios? So under which method is this done? Now look at the following options also. Okay. Yeah. So look at the following options also. Correlation method, historical simulation method, Monte Carlo simulation method, and backtesting. So which is the method used? VR is calculated using a sample of randomly generated price scenarios. Under which method? So randomly generated price scenarios, correlation, historical simulation, Monte Carlo, or backtesting. Think of it, everyone. Under which method is this done? So the answer is, think of it. First here, okay, let me clarify a few methods over here. Correlation method. Correlation method, you are having it in your ABM mainly. Correlation and regression. Here two elements are compared. Always remember, here only two elements are compared. Any two. There can be two scenarios, two situations, anything. But two elements are compared. But in practical life, we have many elements coming up at the same time. Okay, so correlation is that. Historical simulation means what? It is based on the history. So it is a similar sort of back testing. Means here we consider the historical data for last 10 years or 20 years or 30 years depending on the bank. So we consider the historical data and the bank's risk department, and then based on that we can create the scenarios. Okay. Now there is a problem in this, means whatever has happened in earlier life, similar thing will happen. That's what is assumed. But there is a problem in this. For example, I'll give you in 2019. If I'd have asked you in November 2019, everyone pay attention. Will the world come to a halt in next few months? All of you would have called anyone who is calling this that the world will come to a halt. You would have called that person a lunatic, mad, right? But what happened? It did come to a halt. 2020 and 21, completely the entire world was at the pause, right? So backtesting is a problem, because what has not happened earlier may happen later. So that is historical simulation. Monte Carlo means what? Monte Carlo simulation is a simulation of generated scenarios. So now this is fitting this question. Okay. So Monte Carlo simulation is the right answer. C is the right answer. Okay. Now Monte Carlo simulation, let me give you some details of Monte Carlo simulation. Okay. Monte Carlo simulation method, it calculates a change in the value of the portfolio using a sample of randomly generated scenarios. Okay, randomly generated scenarios by making assumptions about the market structures. Market structure means whatever will be the future of the market. Correlation between the risk factors and the volatility. So it uses correlation also. Okay, risk factor and the volatility. It is opposite to that of the historical simulation, right? Opposite. Why? Because in historical, what do we do? What has happened earlier will happen in future. But in Monte Carlo, randomly generated. What has not happened earlier may happen in future. Okay. As in this, it uses views and experience of, as opposed to the naive approach or the used approach. Okay. Naive means it's the same old method used. Okay. The simulation method is best for all the three methods, right? So that's why here, future you don't know, but you can assume about the future through some learned man, right? So that is the first answer. Which of the following are eligible for financial collateral? Financial, okay? Which of them are eligible? This is a module B question. Mutual funds and equities. Debt securities rated by chosen credit rating agency, attracting 100%. This is 100% of or lesser risk weight, rated at least BBB minus when issued by the public sector. Kisan Vikas Patra, life insurance policies, gold. So which of them are eligible as a financial collateral over here? What can you, suppose if I come to you tomorrow, okay, in a bank for loan, I'll ask you, sir, I want the loan, sir, madam, whatever, and these are my collaterals. Will you accept them? Mutual fund, equities. Debt securities means bonds issued by some credit rating agency, at least BBB minus. So will you accept them? Or I am having Kisan Vikas Patra, life insurance policies, right? What do we call this loan? This is known as loan against securities. Loan, LAS we call it, loan against securities. Okay. All the three, see here, all the three are commonly called as loan against securities. Okay. Because securities means what? These are all paper securities. Okay. So now what is this called as? Which of them are eligible? All of them are eligible. Mutual fund equities, yes. Debt securities, yes. Kisan Vikas Patra, LIC, yes. Okay. Generally for mutual fund and equities, we give loan up to 60%. Generally 60%. Okay. For this debt bonds, again we give up to, depending on the rating, we give up to around 60 to 70%. Okay. 60 to 70%. Some banks may give up to 80% also, but general rule is 60 to 70. LIC policies, this LIC policies, Kisan, these are sure shot, these financial collaterals. So against this, we give the loan of around, here against LIC I'm telling you specifically, some banks give around 80% of the sum assured. 80%. Depending on bank to bank, it's there. Whatever is that what the amount, okay? So 80% of, not sum assured actually. I said sum assured of what? No, it's not sum assured. 80% of your surrender value. Surrender. Sum assured is totally different. Surrender value, okay? So what is the answer over here? All the three. D, 1, 2 and 3. Got it? Next one. Which of the following is a correct definition of Macaulay duration? Macaulay. Remember, there are two durations. What are the two durations? Who can give me? Type in the comment section. What are the two durations? What are those? Type in the comment section. Which are the two durations? Yes. Which are the two durations? Comment section, everyone. Let me see. Yes. Two durations are, one is Macaulay, second is modified. Macaulay. And second is modified. Okay, modified. Got it? So what is the definition of Macaulay and modified? Let's see. It is defined as the weighted average to cash flow of a bond where the weights are nothing but the present value of the cash flow themselves. It is a net sum of cash flows and cash inflows and outflows. It is a ratio between the fixed income portfolio's price sensitivity to interest rates changes. It calculates the investment rate of return and annual growth rate. So what is the correct answer over here? Definition of Macaulay. Let me see. Yes. Is it this sum of cash inflows and outflows? Is this cash inflow and cash outflow net sum? No, that is wrong. Okay. Ratio, it's not a ratio between fixed price, what fixed income portfolio's price to interest rate changes. No, this is totally out because this is not related to Macaulay. Investment rate of return and annual growth rate. No, it does not calculate the growth rate at all. It never calculates the growth rate. It is basically this weighted average. Here, firstly understand what is Macaulay. Macaulay means that period in the bond, that period in the life of the bond, okay, in life of the bond, where where the interest rate risk is zeroized. Rate risk is nullified or zeroized. Okay, nullified. Okay, that is known as this Macaulay duration. Got it? So nullified means what? The other words for saying this is this. It is defined as the weighted average to cash flows of a bond where the weights are nothing but the present value of the cash flow themselves. Okay, present value. See here, further I can give you this. It is expressed in years. Always remember, Macaulay is expressed in years and modified is expressed in percentage. The duration of the fixed income security is always shorter than its term to maturity. So this Macaulay duration will always be less than the life. Only in case of zero coupon bonds it's same, except in case of zero coupon bonds where it is same. Okay. Modified duration measures, see here, now I'm talking of modified. Modified duration measures the price change in the bond given as a percentage of change in this interest rates. So that is for modified. Got it? So Macaulay and modified. Got the clarity? Clear? Next one. Now you have to define this correctly. These are the four options and you have to define this. Liquidity risk. Now answer this. What is the definition of liquidity risk? Risk related to purchasing power, power of income. Risk related to firm's capital structure. Risk related to inability to pay its dues on time. Risk related to fluctuations in profits. Now think over it. What is the answer? Yes? What is the answer? Yes? Answer is, what is the answer for liquidity risk? Everyone, what is the answer for liquidity risk? Is this the answer? Drawing power, purchasing power, okay? Purchasing power, that is related to inflation. Related to firm's capital structure, that is also not. Capital structure is related to a balance sheet part. This is the right answer. Risk related to inability to pay the dues on time. See here, when will you say yourself that you are not liquid? Generally check yourself only. At the start of whenever you have the salary, for first week you are the king. From second week you are not the king, right? Because then you have a crunch of money. So that's called a liquidity problem. Okay. So to put it in other words, what I mean by liquidity risk? Liquidity risk occurs when the individual investor, a firm or any financial institution is unable to satisfy its short-term obligations. I'm not able to pay the EMI. I'm not able to pay my school fees. Okay. Due to the shortage of the buyers or inefficient market, the investor or the corporation may be unable to turn the assets into cash. Means they may be unable to sell the bonds because of this no buyers. This generally happens in illiquid market. Okay. So that's the basic problem of your liquidity risk. Got it? Second one, business risk. Risk for related to purchasing power of the income. Risk related to firm's capital structure. Risk related to inability to pay its dues. So this is gone now. Leave this. Third one, risk related to fluctuations in the profits. Now what is this then? What is this? Right? What are we talking of? We are talking of business risk. Business risk means basically a company's business. So business, company's business, when do we call anything as a business? When we have profits, right? Only. Every company net exists for what? Every company exists for profits, right? So if I have profits, only then my business is going well. Otherwise, what's the use? Right? Nokia phone. What happened to Nokia phone? Nokia phones were in huge profit in the time 2004 to 2008-9, right? Now where is Nokia phone? No profits, gone. Okay. So what is the answer over here? The answer is this. Fourth, risk related to fluctuations in the profits. Let me mark this. Where is the cursor? Yeah. This is the answer. Risk related to fluctuations in the profits. That is the answer of this business risk. Okay. So, because what is business risk? Business risk refers to companies or organizations' exposures to the factors that could reduce the profitability or cause it to fail, isn't it? As I gave you the example of Nokia. Similarly, that there was one more company, Kodak. Anyone remember this? New generation doesn't even remember this Kodak because that was in earlier film. Fujifilm. There was one company called as Fujifilm. Where are these companies now? Gone, isn't it? So, reduce the profitability or cause it to fail. Business risk is anything that jeopardizes the company's capacity to meet its financial objectives, means long-term objectives. So that is business risk. Got it? Clear everyone? Business is related to long-term. That is also called as, this other name for business risk is strategic risk. This is also one name, strategic risk. Okay? This is also called as business risk. So long-term objective. Next, financial risk. So now see this. This is gone. This is gone. Now these two. Financial risk related to purchasing power of the income and related to firm's capital structure. Now think over it. Is it related to purchasing power or is it relating to firm's capital structure? Only two options now. What do you think? Okay, what is financial risk in your life? Forget the company. What is a financial risk in your? Suppose if I tell you to invest in shares, what will you say? Sir, there is a problem. Whether the shares will go up or down, my money will, I may lose. So financial risk means what? It's related to losing the money, isn't it? Losing the money. So the danger of losing the money on an investment or a business venture is basically the financial risk. Losing the money, okay, on an investment or any business you start. So it is for mainly related to the money, principal amount, capital, okay. So this capital means the principal amount, what have I invested. So the answer is risk related to firm's capital structure. Got it? Now I'll ask you a separate question, because now if I give you the fourth one option, you'll immediately, I'll give you the name and you'll give me the answer. But now I'll do the reverse thing. What is this risk called as? Risk related to purchasing power of income. What is this risk called as? Risk related to purchasing power of income. What is this risk called as? So because if I give you the name over here, you will immediately say, sir, first. Why? Because you know already 3 are gone, so 1 is remaining. So I'll ask the reverse question now. What is this called as? Risk related to purchasing power. Who reduces the purchasing power of any income? Suppose let's say if I am having 1000 rupees today, okay, will the value of 1000 rupees be same after 20 years? Check yourself only. What you could buy rupees 1000 20 years back, are you able to buy the same thing now? No. Why? What has increased? What has increased? Inflation. Inflation eats up the purchasing power. Always remember, inflation. So the answer is inflation risk. So this is gone, this is gone, this is gone. So now inflation risk relates to risk related to purchasing power of the income. Purchasing power, okay. So here remember, what is the value of money? Value of money is to purchase the goods. If I am not able to purchase anything, the goods using this money, then will I use that money? No, right? So risk related to purchasing power, and purchasing power will always eat up, it will be always eaten up by what? By this, my inflation risk, okay. Clear this point? Concept cleared? So done. Inflation. Inflation is the biggest headache of any central bank. RBI also always focuses on inflation only. Once the inflation goes up, people start revolting against the government. That's why inflation is the main focus of every central bank. As I told you before going, I'll be showing you how to join the Adda 24/7 batches. Here, go to Adda 24/7. I'll always suggest you to go through the app. In the app, you get 1% extra using the coin systems. So go to Adda 24/7. Click on JAIIB and CAIIB. Click on CAIIB. Done. See this crash course. Join it ASAP, 11th October. Okay. Ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos, limited size batches. 11th October means today. Okay. Join it ASAP. Click on buy now. Look at the discount part. Put the code Y432. See, discount is huge right now. 79% plus 1% extra using the app. So 80% discount you are getting. Join it ASAP. Okay, right batch, right time, right spot. Okay. So also you can join the Mahapack. In Mahapack you are getting 15 plus batches per subject. That is also good thing. 15 plus. That many times revision you can do. Isn't it? Same 79% discount is available here also. Never forget the code Y432. Okay.